Welcome to the Explainer. Today, we're slicing through a pretty dense equity research report on Ratnaveer Precision Engineering. We'll be looking at their latest FY 2026 data to see exactly what makes this company tick under the hood. If you love tearing down financial models to understand the real fundamental and technical drivers, you are absolutely in the right place.
Real quick, here's our roadmap for today. First, we'll look at a precision profit surge. Then, reading the market trends. Third, valuation and institutional backing. Fourth, the final scorecard. And finally, risks and key triggers. Let's get right into it.
Section 1. A precision profit surge.
Okay, the number that literally jumps off the page from the FY 2026 data is this: a massive 37.36% surge in annual net profit, hitting 64.31 crore rupees. In the industrial manufacturing space, a bottom-line jump of that magnitude is a huge signal of operational resilience. But, we have to ask, how did they actually pull that off?
Well, look at this. Top-line revenue grew a very solid 20% or so, crossing 1,068 crores. But look at the bottom line. Profit grew at almost double that rate. Plus, Q4 EBITDA spiked almost 70% year over year. Guys, that is the very definition of operational leverage. They aren't just selling more stuff. Their operations are so dialed in that a much larger chunk of every new rupee is dropping straight to the bottom line.
And this profit engine is protected by a remarkably wide moat. We're talking aerospace, automotive, and industrial machinery. They specialize in high-value precision stainless steel, specialized washers, pipes, sheet metal components, that sort of thing. Being diversified across these heavy-hitting industries, combined with really disciplined capital allocation and healthy debt management, gives them a highly resilient revenue stream.
Section 2. Reading the market trends. Now, fundamentals tell us what to buy, right? But technicals tell analysts when to buy. Currently, this stock is coasting above all its major moving averages, the 50, 100, and 200-day horizons. Mathematically speaking, that confirms a solid, bullish long-term trend. Buyers are just consistently stepping up at higher prices across the short, medium, and long term.
The momentum indicators are totally backing this up too. The 14-day RSI is hovering around 58. That's basically the neutral to bullish sweet spot. It means the stock has plenty of runway left before it hits technically overbought territory. Pair that with a bullish MACD crossover, and the momentum is clearly pointing to the upside.
So where are the battle lines actually drawn? We've got immediate support holding steady at 17 rupees, with a major floor down at 155. On the flip side, resistance is right near the 52-week high at 196. Break through that, and the next target is 225. It's a really clear map of exactly where supply and demand are clashing right now.
Section 3. Valuation and institutional backing.
So who actually owns this thing? Promoters hold a stable majority at over 50%. That is always great to see. It means the founders have serious skin in the game. The public holds about 48%, and foreign institutional investors currently have a small but notable 1.23% slice. Overall, a very stable ownership foundation for the stock.
Before we get into the valuation numbers, let's quickly touch on the PEG ratio. If you're trying to combine value and growth, the PEG ratio is your best friend. It simply measures a stock's current price to earnings against its expected future growth. A lower PEG, basically you're paying less for future growth.
And here is the kicker. Ratnaveer's PE ratio sits under 1.0. Combine that with a trailing PE of around 16.2, which is super competitive for the sector, and a reasonable price-to-book ratio for an asset-heavy industrial player. To analysts, this strongly suggests the stock is undervalued relative to its growth potential. It's a genuinely attractive setup if you have a moderate to high-risk appetite.
Section 4. The final scorecard. When you roll all these distinct data points together, Ratnaveer scores a very robust 77 out of 100. Notice how this is heavily anchored by fantastic grades in fundamental strength, scoring an 82, and valuation, and an 85. The institutional score is a bit lower at 65, but honestly, that's completely typical for a company at this specific stage of growth.
So, the final verdict? The research report drops a high-confidence buy recommendation, suggesting a 3 to 5% core portfolio allocation. Looking at the technicals we just covered, they're eyeing an entry zone right between 175 and 180 rupees, protected by a strict stop loss at 150.
To really visualize the risk-reward here, let's contrast the extremes.
You've got a pessimistic bear case target of 160 rupees, directly against a wildly optimistic bull case of 275. For some context, the general consensus base case sits right in the middle, around 235. It is a pretty fascinating risk-to-reward asymmetry, assuming the growth narrative holds up.
Section 5. Risks and Key Triggers. But hold on, let's be real for a second. What could possibly go wrong? It is incredibly easy to get blinded by a 37% profit surge, but any smart learner has to look for the blind spots. What could actually derail this growth?
While the report highlights 3 massive threats. First, raw materials. Sudden spikes in stainless steel or nickel prices could absolutely crush their margins. Second, a global capex slowdown. If aerospace or global manufacturing hits the brakes, their order inflows take a direct hit. And finally, competition. They are constantly facing brutal pricing warfare from larger, established OEMs.
On the flip side, what has to go right to hit that 275 rupee bull target? Mainly 3 things. They have to successfully execute their capacity expansions. They need to keep the export orders flowing, especially for precision fasteners. And crucially, they have to defend those impressive 11 to 12% EBITDA margins by keeping high-value components in the mix.
Quick reminder, everyone, this explainer objectively breaks down a third-party research report for educational purposes, really just to model analysts' thinking. It should never be taken as direct financial advice. Always do your own homework and consult a pro before making any moves.
So, we've seen the mechanics of their profit surge, the technical momentum, and the valuation gap. But it leaves us with one massive, lingering question. As Ratnaveer continues to expand its capacity and push into higher-margin exports, how are they actually going to stack up against the established titans of the major global steel industry? Something to think about. Thanks for joining me on The Explainer, and keep questioning the data.